Good afternoon, everybody, and thank you for joining us this afternoon. Today is our final session in our series that we were running with Trilegal Masterclasses in Deal Processes. We have had, I think, a great series this time. We started off with a session on term sheets. We went on to talk about how due diligence practices have changed in the wake of the pandemic. And today we're going to talk about M&A and exit strategies with Harsh and Ashutosh, who are both, I don't know what's the right word, but I don't think we could have had more experienced and more insightful instructors for today's session. Between the two of them, I think they would have handled complicated, large scale, and a number of transactions. And I'm really excited and looking forward to hearing and learning a lot today. Thank you very much, everybody. And thank you very much, Harsh and Ashutosh. Our basic housekeeping rules, please keep your cameras on or off. It's up to you, but please keep your mics off. Whatever comments and questions you have, please put them in the chat box. Harsh and Ashutosh will try and address the questions in the course of the session. And for any questions that are left, we will take them up at the end of the session. The recording for today will be put up on WinPE's YouTube channel, and we will send a link to everybody who's here. So with that, thank you, and over to you, Harsh.
Right. Thanks a lot, Nupur. Good afternoon, everybody, and thank you for taking some time out on a Saturday afternoon to attend this session. My name is Harsh. I'm a partner at Trilegal, and I'm part of the corporate practice group. Do a fair bit of M&A. I've been doing that for the last 10 to 12 years now. And the idea today is to focus on exits and exit strategies from an M&A perspective. I have with me joining us today as well is Ashutosh, and have worked closely with Ashutosh over a number of years now, including specifically on the topic that we plan to cover today, which are exits. And Ashutosh is Ashutosh, you want to just introduce yourself, and before that, after that, I can just go into the presentation.
Sure. So hi, everyone. I am a freelance consultant as of now. I've been working with various private equity funds on investing and exits. And apart from that, I also have experience in early stage investing and public markets. So as Harsh mentioned, we have worked together on many exits over the years. And we basically would have worked around, I have done like 6 exits for private equity funds. So quite happy to share whatever I can. And if there are any questions, please kind of let me know, and I'll touch upon from my experience what I've learned.
Thanks a lot, Ashutosh. So let's dive straight in. I think we would like to keep this as interactive as possible. So feel free to ask any questions, or even if you don't have any questions, but you have a comment or insight or anything at all, feel free to just put that in the chat box. And I know we are limited by time, but we'll try responding to as many as we can, right? So let's start straight in, right? Let me begin by this picture, and I'd just like to ask anybody, does anybody in the forum know what this picture represents or what it is? Okay, fine. I think I'll go ahead anyway. So this picture is an illustration from Mahabharata, and it's supposed to represent the Chakravyu, the famous Chakravyu which Abhimanyu goes into. And the reason why I wanted to begin this presentation by this image is because I think most of you would be aware, and if not, then it's a very interesting story to know about. What happens is that on the final day of the Kurukshetra war, I think it's the final day, I'm not sure, Abhimanyu, who's a great warrior in his own right, enters this battle formation, which is the Chakravyu, and he manages to slay most of the, he manages to penetrate it, but he can't really exit and he can't really get out of it, and that's where he gets slain. And I think that's something which often ends up happening in the investing world as well. And it's a good analogy to draw how some of the greatest warriors are go into good, and you're facing on the other side equally good companies or equally good warriors, and you sort of get into this situation where you're there and you might be winning, or in quote unquote winning in some sense, but you're not really being able to get out. And that's really the story of the lesson from or the analogy that one would that I'd like to point to, right? Because as important as it is to invest, it is equally important to know how to exit, right? And ultimately, that's, as from an investor's perspective, whatever you have thought in terms of the business case of the company that you want to invest in, the kind of returns you want to make, ultimately, if you don't get an exit, it's all just theory, right? So because and therefore it's very important to, a lot of fun, the headlines or the energy gets focused on entries, which of course no doubt important. And you need to also know, okay, once you have invested, how you're going to run the company or how you're going to manage your rights in the company. But I think, like most organizations focus on entries, it's equally important to focus on exits, especially from an investor's perspective, right? So because as I say, if you don't, then it's as good as as sunk cash, right? If you're not able to get any exit eventually. So that's really the point here, right? Just to give you a perspective or of overview of what are some trends in the M&A exits that we are seeing lately, right? So 2020 was, as you can imagine, a bit of a down year because of COVID. There wasn't really that much activity in that sense. But what we have seen in the last few months, 2021 has picked up, right? In H1 itself, the exits by PE investors was almost 5.4 times the the exit value of H2 2021, right? And if you see the statistics, almost, we are hearing a lot of blockbuster IPOs we're hearing a lot about blockbuster IPOs this year. And the trend over last year and this year is that almost 55% of the money raised in IPOs is actually going towards VC and PE exits, right? Which is at a 5-year high. Just by way of comparison, it's usually ranges between the 20 to 30% range. So there is definitely an uptake this year in exit activity through M&A or IPOs or other different methods, right? Couple of high profile ones, which I'm sure you all would have read of, right? There's the BillDesk sale to process, which just got announced a few days back. That's an interesting one. I've personally worked on that. So that was a good, I'll be happy to sort of talk about that a little later. That was done. So that exit just got announced was almost a $4.5 billion exit. It's 100% exit through a strategic sale, right? So that's one kind of exit. The other kind of exit you all would have heard about is Zomato, where there was a major listing event just a month or so ago. A number of PE funds, as well as, in fact, small shareholders, ESOP beneficiaries also managed to get good returns on that. Then there's just another example could be Alibaba exiting from Big Basket. Now that's a slightly different one. It is also a straight exit to a strategic acquirer. So in that sense, it's sort of similar to BillDesk, but it's slightly different because there the there are the founders continue to play a role, whereas in some of the other exits that may not be the case. And what really is driving all of this, right? So there's obviously some amount of pent up M&A demand. Last year was a down year in many ways. So this year you can see a rebound of sorts happening in terms of just deal activity. stock markets are at an all-time high, and number of IPOs are continuing being announced and are in the table. And from a business or a macro perspective, right, I think there's in a number of industries or sectors, there's now consolidation happening. So just from business sense, it makes sense for some players to exit, get the returns that they wish to or that they're able to. And from business, because otherwise it's just not sustainable for those businesses to survive in the long run. So there's some amount of consolidation, particularly in the tech space, and that's something which we have seen happening.
So maybe I'll take us through the slide. So this is how I see the PE industry, which has evolved in India. And the reason I feel that this is very contextual, even for exits, is one should realize that this is not a very old industry. So even though PE investments have been happening maybe for 2 decades now, but really the depth of the PE market has really over the last 10 years is when you can actually see PE investors kind of really coming in with a lot of money, and also on the promoter side and the founders side, they realizing what PE money is and what PE investors are. Like they are more like partners and are not, and they just don't bring capital to the company. They can also bring in a lot of strategic advantage, a lot of business, and a lot of discipline within the company, which will be very useful as the company moves forward, either to raise subsequent capital or for various exit options, which Harsh mentioned. It is important to bring in that discipline, and unless a third party kind of comes in, sometimes it's difficult to get that. So this is a way how how the industry has evolved. Initial years have been much more constrained in terms of private equity being available in the country, and that's why you see so many companies having IPO'd, and we have like 5,000, 6,000 companies on the markets, which is very unique in a sense. You don't see any other country where so many companies have IPO'd or are listed, and the reason was lack of private equity, which was there. And as the space evolved, there were a lot many options for companies and founders to raise equity, which were private, but at the same time it involved bringing in these partners and giving them rights. And there were some kind of misalignments over a period of time where the interest of the founders in the PE industry didn't kind of match. But on an overall basis, things have kind of smoothened out, and there have been many exits, and PE industry is now quite comfortable in investing in India in various companies, and they have a lot of PE exit options, which we'll see later, which they have been able to kind of use. Over to you, Harsh.
Yeah. Okay. So let me just spend some time talking about the various exit options that are there, right? And but for a typical PE or VC investor, or for any investor really, and this is an illustration. This is by no means all, but it sort of represents the most common ways of exiting or getting an exit from your investing company, from your investee company, right? Sometimes you do a combination of one or two, as I'll talk about. That's also an option. But and each one has its pros and cons, has its peculiarities, has its nuances. So there is not really one right answer. If someone were to ever ask the question, what is the best option or what is the best way to exit a company, there is no one answer. It really depends on a lot of factors. But these are the most typical and most common ways of exiting, right? The first one is an IPO, right? And that I think you all would have heard in some context or the other. Essentially, what happens in an IPO exit is that the company where an investor has invested goes public, right? And that could be through various ways, but it goes public. And once that goes public, what that allows the investor to do is have a ready market to sell its shares in the company and therefore exit the company, get some return and get it. Otherwise, the typical issue is that, in if it is not listed, the um, the market for that is really small. You have to go find a buyer by yourself, and it depends on your private companies will have all sorts of restrictions. There will be other shareholders, there will be shareholders agreements. So there will be challenges around just for one particular investor to go just sell its stake. But once a company becomes public, it gets the ability to freely trade those shares. There are, of course, some restrictions. I'll come to that, but that's really how the IPO serves to be an exit option. Of course, there is a SEBI process that one has to go through. We'll come to that. And there are it takes time. You need to prepare the company for an IPO, and some IPOs are successful, some are not. But essentially, that's one way. And of course, that is one of the most common ways, as Ashutosh was saying, especially when the PE secondary market is not as deep, then the IPO does become an option, and especially these days, right? If the markets are on a high, then that also gives an impetus for other companies to try to list and give exits to their investors through that method, right? The other method is stake sales. Stake sales are essentially where an investor would sell its stake to a buyer. It's a buyer, there's a buyer who is identified and they sell, and there's a bilateral rate. Stake sales can be of various types. It can either be a strategic acquirer who comes and buys the stake, which is, essentially somebody who's interested in the underlying business or is in the same sector, or it could be a secondary buyout by another PE firm. So you, as the holder of those shares, are now reaching the end of your investment cycle. You want to get out, get your returns. So you find another PE firm who is now at their early stages of order at an investing stage. You negotiate a deal at a price which works for both of you, and that's how the exit is completed, by you selling your stake and a new person, new investor coming in, right? These two, in my view, are the most common ones in today's day and age as the modes for PE investors to get exits. And stake sales are comparative. I mean, it depends how you look at it, I guess. They are certainly easier in the sense that in most situations, there's no regulatory process involved, unlike a SEBI process, etc. And the company doesn't, needs to get to a certain level of maturity before it can IPO, unlike an IPO situation. So that those issues are not there. But of course, it really requires some amount of cooperation with the rest of the shareholders in the company, or let me rephrase that, perhaps not cooperation, but some amount of dependency on either the founders or on the other shareholders, because essentially what is happening is that there are a group of shareholders, you are going out, somebody else is coming in, right? So it has to be within the framework of what you have agreed to with the other shareholders, or what you have agreed to with the founders, that okay, so those are the two most common ones in today's day and age. Third option is buyback. Buyback is where the company buys back the shares of the investor and gives cash in return for that. And that is technically possible. There have been a few of those cases, a few of those exits as well. But lately, not so much. The challenge there comes in is that the buyback is really where the company is buying back the shares from an investor, right? And there are limitations under the Companies Act as to how much you can buy back from an investor, what value you can do, what kind of funds you can use to buy back. So there are some inherent limitations under the regulatory regime which circumvents which limits how much how much this option can be used. There are put options as well, where essentially the investor would put the shares, i.e. require the founders or the promoters to buy those shares from the company at a fixed price or at a agreed price, right? So you'll say, okay, now I've reached my end of my investment cycle. Now you have to buy these shares back from me and give me an exit, right? So that's a contractual arrangement which is there. The drag along is a right which is there where the investor can sell its shares to a third party, but because and can also sort of force other investors to also sell their shares in the company to that third party. And the reason for that is that as an investor, you might be owning a 20% or a 30% stake in the company, whereas a third party buyer may not be interested in just acquiring a 30% stake. For them, it might be an all or nothing deal and they want the full company. So the drag along right allows you to force the other person's, or quote unquote drag along the other shareholders to also sell their shares to the other person. Basically, you make your stake more marketable. A 30% stake would not be as marketable as a 100% stake. That's really the underlying thought behind that. Yeah. Mergers are another way. So where if you hold a stake, if an investor holds a stake in a unlisted company, all right, and they are not being able to get an exit, you could merge that company with a listed company and therefore get listed company shares in return for that, and therefore have a tradable stock which you can then sell and get your exit by selling those shares in the market, right? So that's mergers as a way of exit. Asset sales are where the shares themselves might not be marketable for whatever reason, but the company holds a valuable asset. It might own land, it might own IP, it might own a manufacturing facility for whatever reason, because of either legal or commercial, you're not being able to sell your shares. So what can be done is that the company sells its assets, and the proceeds of that is used to give exit to the investor. And then, of course, there are REITs and InvITs. These are more new in the space. These are essentially structures which allow investors to monetize investments in the real estate and infra space. And also, I guess it's somewhat similar in some senses to making a company go public, but where, because there are ability for public unit holders to be part of this process, and essentially once the rate or InvIT is in place, there is a lot more liquidity that comes in associated with that stake. So these are some of the ways in which one can exit their investments. There are no, as I was saying, there's no one clear way, and each of them, frankly, has its challenges as well, right? Like a drag along right, for instance, it is a very good right to have in your agreement, but practically speaking, not a lot of them have actually played out in the Indian context. So we don't really know how that's going to turn out on the ground, right? Put options as well. In theory, it sounds great. Because what it does is that you do not have the responsibility then of going and finding a buyer for your stake. You are not dependent unlike in an IPO scenario where you have to, whether the company is able to do an IPO or not. It's subject to so many uncertainties, a SEBI process, all that. Put option, in some sense, is a very strong exit, right? Because all it says is that you have already decided that after 5 years, after 6 years, you have to get an exit, and you decide the price and you get it. But all of these, some of these can turn contentious, can turn problematic, right? So in put options, let me just take the example of put options and spend a minute on that, right? what will happen in a put option is that an investor would exercise a put option against the founder, saying that, okay, I've remained invested now for 5 or 6 years. Now it's time to exercise my put. I want my return. Here, buy these shares back from me at this value. And the founder may not have that kind of funds to be able to actually give you that exit, or there might be genuine disagreements on that, on how much your shares are really valuable for, and they might not want to take that kind of liability onto themselves. They are like, you have taken an equity investment, you made an equity investment, you take the risk of that, and they don't want to do that. So this is a negotiation which happens at the time you are entering into your investment. We can see usually, I think the trend which I have seen is that nowadays put options or buybacks are not as favorable, because there's been a history of litigation, or founders not wanting to take on, promoters not wanting to take on personal liability for these kind of exits. IPOs and stake sales, still it's not really them being on the hook in the same sense of the term, and really that's how it's playing out that day. Ashutosh, you want to just come in here about your how your experience has been, what you have seen, and what your experience has been among these various options?
Yeah. So I think as you are aware of, so obviously in my exits, all of these options have been used. But for example, in one particular case, actually we touched upon each of these points. So finally, we ended up having a merger and acquisition through which we got out. But when we started, the idea was that, okay, this company, the promoters don't want to exit. They will either do an IPO, or they will, over a period of time, allow our stake to be purchased by another private equity fund after 4 or 5 years, or by someone else, and we will get an exit. But once we reached that point, the promoters said, listen, we have some other plans. We want to grow this business more. So as of now, IPO doesn't make sense. And we will not be kind of willing for any other partner to come in. So we said, but like our, in a sense, timeline is done. We can maybe wait for 1 or 2 more years, but at least we want some kind of visibility, and if possible, some kind of exit today. So they said, okay, why don't we do this in 1 or 2 years? We will either go for an IPO, or we will buy back your shares. We will raise some money and we will buy back your shares. So we said, okay, let's do that. And then as time passed, they again kind of said that, hey, this is not a great time to again IPO the company. We would want to wait out more, because we are expired. So we won't get the best valuation today, and there could be many reasons. So we said, like we hear you, but like we also need some exit, or at least there needs to be some solid timeline for that. And given that there was no kind of agreement on that aspect, we had no option but to kind of think very creatively about what all can be done. We thought about asset sales, for example. We thought about how we can bring in, how we'll have to kind of, if required, take the promoter on in a fight and go towards a put option or a drag along. So that's what we had to creatively think. And finally, we did actually go towards the path of the put option, and we had to kind of fight a legal battle for 4 or 5 years, and which finally led to a merger and acquisition and giving us exit. But the point is, as Harsh mentioned, all of these are possible, and in fact, in some of the assets, things will change a lot, and depending on the situation, either the market situation or internally, how things are within your fund or with the promoter, how interests are aligned, you will have to kind of think creatively about what are your exit options, and everything in a sense is on the table.
Yeah. I think there are a couple of questions which have come in. So let me just quickly take a response to a few of them. I'll just go through the last one first. One of the questions is, aren't subsequent rounds of funding an exit option? So not technically. It really depends on how that funding round is structured. If it is a primary investment, which is fresh money coming into the company, then that doesn't really give you an exit. That just dilutes your stake. It's good for the company, but as an investor, you're not really got an exit unless the subsequent funding round is also structured as a mix of a secondary and primary, where part of the shares are being bought or entirely your stake, an investor stake is being bought. Only then in that situation would that get counted as an exit. But yes, you're right. It can, subsequent funding round can be, but then it's essentially like a stake sale, right? So that's what's happening, right? There is a question around would put options at fixed price face any challenges in terms of being viewed as an assured return in case of a non-resident PE investor? Absolutely. This has been an issue in the Indian legal regime for a while. In fact, the Ashutosh and I have worked on a situation where exactly this issue was there. We exercised a put option, and the promoter's argument was exactly this: that it's a fixed return and therefore not permissible under Indian foreign exchange regulations. If you see what has happened now is that nowadays whatever put options are being at some point of time, there was still a little bit of there was a lack of clarity on this point, and so the people still took that view that okay, there could be an argument made. But I think now the law is very clear: fixed return put options in the case of non-resident investors are not allowed, and therefore nowadays whatever put options are written, which are few in number, are always written as fixed as fair value or valuation related options, put options. One question is around asset saying being similar to buybacks. Well, in some sense, yeah, you do an asset sale, you get proceeds, and then you buy back the shares. So yeah, it is something like that. Yeah,
I think there could be just one difference where buyback can be from the company, or sometimes it can be from the promoters, where promoters are arranging personally money and buying back your shares, while asset sales necessarily will have to be from the company.
Yeah. Okay, I think there are a few more, but I'll just move on to the next one. Right, Ashutosh, you want to just come in here?
Yeah, so I think this is just reiterating the point about exits actually kind of driving your investment. So for example, when I joined the industry, the first thing which comes to mind when you're looking at any investment is, hey, what is the sector? Like how much returns will it make? This investment make if I get in and I get out? And slowly you realize that okay, so that's important, but actually returns is more like a result. There are a lot of other things. So, for example, market size I mentioned, but who are the promoters? What is their integrity? What has been the experience of other investors with them, etc., etc. So you realize, okay, those are important software issues which you typically don't consider because you look at Excel and you see what is your entry valuation, what are your cash flows, what will be your exit. Then there are other factors like environmental, social, and governance issues, which are becoming prominent. But actually, in a sense, to put the cart before the horse, exit is the most important thing which should be there in your mind when you are looking to do an investment, because really all of this returns, promoters, etc. These are as Harsh mentioned, right? So it will be like money down the drain if you're really not able to exit, because finally, as an investor, your aim is to make the returns, and actually it should be cash on cash rather than something on the books. And as a fiduciary duty to your investors as well, you need to ensure that you're returning back the money in the timeline and all of those. So I would say exit is like the most critical in your investment thesis, or it is at least as critical as returns and promoters, how the promoters are.
Absolutely.
Again, so this was more to give you a perspective. So we obviously are talking a lot on the private equity space, but there are, I would say, some difference between private equity versus VC, which is more venture investments, versus public markets. One, how liquid the investments are. So one great thing about, for example, public markets is that typically these investments are very liquid. And unless you have a significant stake in the company, it is always possible that you get a window within the next 1 or 2 years to exit your investment. While in VC and PE, it is tougher. The one question, for example, which came in the chat box was around the next funding round being an exit way to exit. It is possible, For example, in VCs, it is quite possible, but then the new investors typically want to put in money as primary capital in the company. And it's not, unless the company is doing really well and they want anyhow want some shares, they would want primary shares rather than secondary shares. So really the option for even in VC investments is the company to grow pretty big and then either go for an IPO or there is a merger and acquisition. So liquidity in PE VC is quite constrained versus the public markets. Second is in PE, for example, alignment with all the stakeholders and primarily the promoters is very important for exit, because in a sense, when you are investing, the capital is coming to the company and it is required and there is still alignment. But when you want to exit, it may not always, the promoters and the private equity investor may not always be aligned, because the promoters will have their own priorities, and there would be some requirement of time and commitment and effort from the company and from the promoters for to get you an exit. So so they need to see some value to them, and only then will they, in a sense, totally kind of be with you in your exit. Third is a related point on dependence on the founders. The fourth options, which Harsh has already taken you through, what are the various options in terms of exits. And again, as I said, PE versus VC versus public markets are very different options which the investor has for exiting. And then market timing is very critical in all of them. So for example, today, like venture investing is quite, people are quite bullish on venture investing. Even like a retail investor or an institutional or an investor, HNI investor who can invest maybe 10 lakhs per company, he is looking out for deals in the early stage venture space. So today is a great time, for example, for VC investors to, for venture companies to raise money. And similarly, it will be a great time for VC investors to exit, as Harsh mentioned a couple of M&As which have recently happened. But 3 years down, 3 years before this, it was not a great time, and people expect maybe 2 years down the line it may not be a great time. So market timing is quite critical when you are exiting, and that should be in your plan. And finally, what valuation and what value you get out of your stake. So that will depend on market timing. That will depend on how what options investors have and how much money is coming in the system, how much money is coming into India. And that will really determine what valuation you can command for while exiting your investment.
Yeah, and just typically, from a legal perspective, what you do is when you are investing, at the time you're investing, is that the investor enters into a shareholders agreement, and there is usually a waterfall which is specified in the agreement. So there is a timeline within which the company is required to do, or they'll try to make sure that they do an IPO within a certain date. Then the next level of the waterfall is, okay, if IPO doesn't happen, then they'll find a strategic buyer, or the other way around, whatever. If that also doesn't happen, then there will be a drag along right or a put option. So, it's a gradual thing which is aimed to incentivize the promoter or the founder as well, to make sure that, okay, if you want to ensure that your stake continues to remain in the company, or you do not have any liability as well, make sure that your company IPOs or you get a buyer for my stake within a certain period of time. So there's usually a waterfall in this in any shareholders agreement. Also keep in mind that PE investments increasingly, and Ashutosh, I don't know if that's been your experience as well, but increasingly a number of sort of significant PE investors, they are actually now taking control stakes, and that's a trend which we are observing in the industry. And as a controlling shareholder, this sort of works slightly differently. An exit is still equally important. There's no two ways about that. But I think some of these equations kind of turn, because as a majority shareholder, you can probably drive the exit process a lot more. So that is certainly, and in fact, I think one of the reasons why people are more interested in taking control positions, apart from the business proposition itself, is also because of the somewhat not so good experiences they've had in trying to get exits, and sort of they've realized along the way that they really need to control that process. Irrespective of what a shareholders agreement says, you need to be the majority shareholder to be able to drive through your entire life cycle of the fund. So I think that's one thing which I have noticed.
Yeah, one other thing on that is also it has happened because over a period of time, even for example the public markets, they have slowly been open to the idea that there is no promoter in a company and there is a professional management which will run it. So there is an example, for example, of Crompton Greaves, where it was majority controlled by PE investors, and it was a listed entity. And over a period of time, once the company grew, like the PE investors kind of sold their stake, and now there is a professional management, and there is no promoter as such.
Correct.
But the market is open to such ideas which they were not earlier.
You're absolutely right. I mean, in fact, just a month or two back, I think people would have read on KTM how the founder is resigned from his promoter role and is now just a managing director, and it's actually majority held by PE institutions. I think we worked recently on an IPO for Sona BLW, which is a OEM manufacturer, and their Blackstone is actually the majority shareholder, and they were the ones who got classified as promoter and not a typical founder or promoter, but actually the PE fund who took on that role. And of course, actual operations are being managed by the professional management. So certainly that's there. So let me just quickly talk about what are the kind of considerations. Timelines is of course an important point, right? IPOs take some significant of time. Even stake sales can end up taking time. There's a diligence process which has to be followed. There are negotiations which happen. If you're doing an auction, then you have to go through an auction process. So timelines is really one important factor. Tax is, from a legal perspective, important because that gets factored into your returns. If there is a significant capital gains liability, which then you need to factor that in, or if there are other tax liabilities because of your exit, you need to factor that into your overall return. There are regulatory processes in some senses, as I was saying. If you are doing an IPO, then there's a SEBI process which needs to be followed. If you are talking about sectoral issues, right? If your investment is in a regulated sector, like if your investment is in an insurance company, then you might have everything lined up. The company is doing great. You have found a buyer is willing to buy. You have achieved. You're on the same page on valuation, etc. But just because of the sectoral issues, that might pose a hurdle. You need a IRDA approval or the insurance regulators approval before you can sell your stake. There might be a competition commission approval which might be required, and if you're selling to a strategic buyer, a strategic buyer might be willing to give you a much more of a premium, but you might feel that there's a chance of CCI taking longer or imposing conditions or asking questions, and that might not tie in with the timelines you are looking at. And therefore, all these factors have to sort of be weighed in together as to, okay, what is the more, like, how do I, all these considerations, how do I work with them together to come up with an exit? Talking about deal certainty, right now, there might be somebody who is willing to give you a great price, but says that I need to raise further capital, or I need to take some debt on to be able to give you an exit, because I want to buy this as a long-term investment, but I have certain liquidity issues. So you as an investor, as a selling shareholder, might ask this question: is this really going to happen? What if that doesn't happen? My exit gets stuck. So this is another sort of parameter by which you will judge on the counterparty, what's the certainty level of the deal, because there is a ticking time clock to your investment, right? Which you need to think about. And then lastly, are residual liabilities. An investor has been in a company for a certain amount of time. When you are exiting it, but you need to think about the way in which you're exiting and on what terms you're exiting, because liabilities during the time you were in the company continue even beyond that. And as professional organizations, they can become big issues. Similarly, if you are required to give indemnities, you are required to give representations on the business, then as part of the exit, then that basically means that while you have got an exit, in case those indemnities get invoked, you could have a residual liability. So you have to agree and negotiate and be very clear on what are your negotiating parameters, how much you can give, what level of risk is acceptable to you, what is market practice. All of these factors are actually discussion points in themselves. I think in the interest of time, I'll just go on. But I think the point is that it's really a complex decision. There's no one factor which takes it all, right? So I think my next 2-3 slides are just to take one or two exit modes as an option, just walk through what are the sort of things which go in that, right? So let's take IPO for example. If this slide sort of gives you a very brief overview of the process, the long and short of it, because we're running out of time, I think, is that an IPO process, assuming everything else is there ready, it takes about 6 months from start to finish just to get it to form, start from the day you decide to the time of listing, right? And that again needs to be factored in. In an IPO exit, there are a few things, right? So an IPO can either be through a fresh issue of money into the company or through an offer for sale where your existing shareholders get an exit. Both are possible options. It really depends on what's the need of the hour at that point of time. There could be situations where an investor, because of the way the market is, may not be able to exit completely, even in an IPO in one day itself, or may not want to exit on day one itself, right? And they will actually be continuing shareholders in the company and exit over a period of time. And therefore, whatever the question then becomes as to what are the kind of rights you can continue to have in a listed company, which you had earlier before the company became listed. And all of these are important because, exits, it's important in the context of exits because exits are not always complete or 100% exit in one go. They could be staggered over periods of time. And if that be the case, then you need to ensure that your rights continue to be protected till the time you've got a full exit or an acceptable level of exit. And therefore you need to preserve your rights. And now what's earlier SEBI's position was that no special rights could be allowed in listed companies. But I think now the position has changed. They do allow certain rights like your director rights to continue even post listing. Of course, there are some conditions and bells and whistles around it. There are lock-in requirements. So if you are as a promoter of the company, then at least 20% of the post-issue capital gets locked in for 18 months. And the remaining shareholding gets locked in for 6 months. Again, this again ties into your exit because if it's locked in under law, you can't sell and exit, no matter, even though it is a listed company in that sense, right? Similarly, even the non-promoter shareholding gets locked in for 6 months. So when you're thinking about an exit or an IPO, it is not just, okay, IPO done and dusted, that's it. You actually have to sort of factor in the timelines, lock-in periods, contribution periods, stuff like that, right? And lastly, one final point around promoters, right? So as we were mentioning a little bit earlier, a number of PE investors now actually own significant stakes in companies who are looking to do IPOs. All the big ones that you're hearing about today, whether it be Paytm, whether it be Zomato, whether it be Snapdeal, which was in the papers 2-3 days back, or a lot of others as well. It's actually majority owned by PE funds. And therefore, with owning such significant stakes, I'm not going into a particular example, but the point is that when you're getting your company ready for an IPO and thinking about an exit, be very conscious about the kind of obligations you are taking on, because as a significant investor in that company, you might get classified as a, and then you are responsible for all the statements, for instance, which are made in the prospectus. That's important because if there could be potential liability concerns there, right? So these are important points while thinking through an IPO process. Stake sales, again, there are a lot of parameters to think about. Stake sales work differently in listed companies versus unlisted companies. One is, of course, the marketability of the stock. In listed companies, there are additional issues around insider trading. If you have a director on the board and you are also planning to sell your stake, there could be concerns that, okay, you as an investor have access to inside information. So what are the kind of safeguards you need to keep in mind? What are the measures you keep in mind? Obviously, all of these doesn't mean that you can't do an exit. It just means your exit gets a little bit more nuanced than a regular exit, right? Partial versus complete exit, as I was saying, if you are exiting partially, then you need to make sure that you are at a level you're comfortable with, you have certain level of rights which continue in the company, which are commensurate to what is your shareholding then in the company, right? Auctions versus negotiated deal. This is more of a timeline and process kind of thing. Auctions take longer, but they can help in better price discovery. So it really depends on how, or you can just sort of hire a banker or somebody else to help you find negotiated deal. So that's one. Strategic acquirers versus financial investors. That's again, so the idea of this is sort of to give you different parameters around how these strategic sales, how stake sales get implemented. In case of strategic acquirers, they look at and invest a company very differently. They will want a controlling stake. They might want certain rights in the company. And the reason why that's important for you as an exiting investor is because ultimately you have to deal with the buyer who you have across the table. If the person is a strategic investor or a strategic acquirer, you have to ultimately have a meeting of minds and make sure that it works for them as well. You can't be thinking the same way as you as a financial investor may have thought about it, right? Then there are minority versus control deals. As I was saying now, in a control deal where you own a significant or you control the company as an investor, at least in terms of your shareholding, you certainly have a lot more ability to drive the exit process. As opposed to this, in a minority stake, you are dependent on some level of cooperation from the founders, because any new investor coming in will want to be comfortable, will want to be comfortable with whichever investment they are getting. From their perspective, they are entering into a new investment, so they want to be comfortable with the founders and make sure that the founder is on the same page as they are. They want a certain level of rights, so and they would want to diligence the company. So all of these things essentially means that it's not entirely in your hands. You do require some amount of cooperation from other shareholders as well. And the last point which I'd like to talk about on stake sales is indemnities versus insurance, right? Now, any person, when you are exiting a company, at least and I'm not talking so much about the listed space because there your stock is already marketable and listed, but mostly in the unlisted space, when you as an investor are exiting and are selling your shares, any buyer on the other side is going to expect certain indemnities, certain insurance from you. Now, there are 2 or 3 ways in which one can handle it. You could either give those indemnities. That's fine if you're comfortable with that level of risk, because you are standing behind certain statements. Then that's one option. Second is you could do it, but you could limit it, saying, okay, I am standing behind it, but only for ABC things which I'm comfortable with, things which I have been involved in. I, as an investor, have not been involved in the business. It's been managed by the management, and therefore I'm not going to give you any indemnities for the business itself, right? So I can give you about my shares, about tax. Those are the sort of things I'm willing to stand behind. So that is the other way of negotiating. But it could also be a situation where the buyer says, or you could say that, you know what, let the promoter or let the founder give the indemnity. I'm just a financial investor. I shouldn't really be on the hook for that. It is the founder's obligation to actually go and find me an exit. So he should be on the hook. That's the third way. I mean, what's the other way one could look at indemnities, right? So these are some of the, but it could very well be possible that in a PE investor might actually be holding the entire company as well. You know, there are some cases where PE investors hold 100% of the company and the company is professionally managed, or significant majority stakes. And then the question is, who is really on the hook for indemnities? Because you have to think of, always please remember that in any exit, you also have to think from the incoming investors' perspective. It's important to do that. Otherwise, the negotiation will just fail or will just drag on unnecessarily. So keep yourself in the shoes of an incoming investor. What would you as an investor want? You will want coverage. You will want certain assurances that the business has been run in a certain way. And if on the other side, you as an exiting investor are not in a position to be able to provide those kind of assurances. The question becomes, who gives that? Because somebody has to be on the hook for that. And so one product which has now become increasingly popular is insurance, where questions are where professional insurers give representation and warranty or indemnity insurance, and you pay a fee to them, you pay the premium to them, but really it's a way of distributing the risk or allocating the risk slightly differently. So that's another thing which we are seeing increasingly, especially in controlled deals where PE investors are hold controlling stakes, right? So this is a short case scenario, which typical issue which would arise in a negotiation during an M&A exit process, right? So here the situation is that ABC is a pharmaceutical company. There's a fund which holds 70% stake in the company. Promoters own 20%, and 10% is held by the management. And they've managed to find a buyer who wants to pick up at 90% stake. Management team will continue to hold the balance 10%, right? Now, as a buyer, because they see value in the business, they do want indemnities from the fund. But as a fund, there are certain limitations which are there, which as a fund, they have not been involved in the business. So they may not be able to give the kind of warrant. Sorry, can I just request others to go on mute, please? They might not be willing to give the, they might not be, it's not about willing, and they just might not be able to give the business. If you're not involved in the business, then how do you actually give an indemnity about the business, right? It's sort of fundamentally a little contradictory. So how does that happen, and what could they do? Right. So that's as I was saying in the earlier one, right? So what are the options that's available? One is, of course, something can't be done, it can't be done, you stick to your negotiating position. And sometimes that's the way it is, and people get comfortable saying that, okay, I may not be giving indemnities, but you do a diligence, become comfortable with the way the business is running. And therefore you completely sort of give full access from a diligence perspective. And therefore an incoming investor at least is comfortable that, okay, I might not get quote unquote indemnities, but I have had an opportunity to study this business. And therefore I'm reasonably comfortable and confident about the way this is run. And I don't really need those indemnities. That's one option that could be done. The other option could be, as I mentioned, you could think about getting insurance. And that's really, I think, the simplest solution. Of course, there's a cost element to it. And there are, of course, questions around what will the insurance cover, what will it not cover, all of those. But I'm not getting into all of those for now, right? That could be other option available. Third option could be, okay, you say, fine, I'll give indemnities, but I will limit my exposure in some ways, right? So whatever I have shared as diligence items, that's something which the acquirer should be comfortable with. I shouldn't be on the hook for that. That's one way that you can limit your exposure. You can say that, okay, I will give indemnities, but perhaps not for the entire duration. I need at some point a certainty that, okay, I have exited this company and now I'm fully out. The issue with indemnities is, and I'll tell you why it becomes a sticky negotiating point, is that you might exit and sell your shares, but till the time an indemnity continues to be live, you're still on the hook. And it's not in that sense a complete exit. It's a complete exit for your shares, but you're still on the hook for your liabilities for whatever your indemnity obligations are. And therefore, it's important to sort of try to see how do you, as an exiting investor, limit your liability. And so you might say, okay, get comfortable, run the business for X number of years, and that's it. I'm not on the hook forever because I need to exit. I'm sort of driving home and re-emphasizing exit, right? And it could also be, right, I mean, if the buyer on the other side is a financial investor as well, just like you, it's really what all of these options, none of them are really unreasonable positions to take, right? Because at the end of the day, at 5 years down the line, 6 years down the line, that investor will be in the same position which you are in today, and they'll be facing with the same issues. So you have to also try to convince them that it's something which you as an investor, as a professional fund, you might not be in a position to actually do. So how do you expect me to do? Or what would you do in your other scenario, other investments? So these are negotiation points which have to be negotiated. Or there are other ways in which you can give comfort, right? So see, as a buyer, what is the risk that they are seeing? They're saying, I need to get coverage. Okay, fine. We solved that through giving indemnity. They might say, what if you take the money, you sell your shares, you take the money, and then you disappear, right? So how do I, as a buyer, protect my risk? And so you have to always be creative and come up with solutions to address those risks, but also protect your interests. From your perspective, you want the ability to get money out and get that return, right? That's what you're investing for. To address the buyer's risk or their concern, because you have to ultimately find a middle ground. You could be creative, right? So insurance is one way. The other is you can say, okay, if you're so concerned about me running away with the money, let my parent entity give you some sort of a comfort letter that, okay, if there is 2 years down the line some obligation, then I, as the parent, as a more substantive entity, I will step in and fulfill those obligations. But do not stop me from distributing my money to my investors, because I need to do that. That is my obligation to my investors to return the money. But I'm giving you the comfort that there is somebody credible on the other side of the table, somebody who has a lot of other assets, who's willing to be on the hook and step in if at all the situation ever arises. So the point, I guess what I'm trying to just drive home the point is that an exit is really negotiated. You have to meet the concerns of the buyer. You have to protect your interests, and you have to ultimately get an exit. That's, I think, the most important point, which I'd like to end my my presentation by. That keep sight of the mind that your ultimate objective is always to get an exit. Of course, I'm not suggesting an exit at all costs. There are certain situations where certain areas would be no cost, but if it broadly meets that, try coming up with creative ways to address the situation which you are in. Yeah, so I think that's we are reaching the end of our time. So thank you all very much for your time. Happy to sort of take any questions that may be there. And yeah, thank you.
Thanks.
Thank you, Harsh, and thank you, Ashutosh.